There's been some turbulence in the market as of late, so let's dissect the S&P 500 and the NASDAQ. First off, read this disclaimer carefully. I recently updated the data here, and there's pressure here as well in the megatrends. Not as much as we see in the S&P 500, but it's pretty clear that the market is now, it is changing its psychology. It's gone from being super bullish to now becoming a lot more balanced in its psychology, which I actually think is healthy. Let's start here with the S&P 500 seasonality. The thing is that the S&P 500, it usually has some correction during the summer and early autumn period. We didn't have that this year. If we look at the NASDAQ, look at the seasonality, we can see that it's something similar here with the NASDAQ. It likes to do that. Well, let's first look at the chart here for the S&P 500. We are using weekly data points, and something I want to highlight to you now, because now we are sort of doing like a psychoanalysis of the S&P 500. In order to get a picture of what we should expect in regards to the current situation, look closely here at this purple 20-week moving average. Now we are all the way back here to 2004, okay? We are getting the big picture here. But something you can see is that it very often likes to pull back to that level. If we go further back as well, here during the bull market after the dot-com bubble, it likes to dance around that moving average. It is obviously very important. Then during a bear market, the 20-week moving average then becomes a key resistance level. Then, when we start to rally and use it as a support level, it is the all clear sign, and throughout the post-financial bear market, we were using the 20-week moving average as a support level throughout. It was a key level. We pull back here, as you can see, very frequently. It is a common thing. It is what we do. When we pull back there and find support, that's when the bulls really like to buy stocks. They feel very comfortable. So that is the theme. That is very clear. As a matter of fact, the evidence is here. It is what happens. The problem with the current rally post-pandemic is that we had a monstrous surge. Basically, what happened down here is that the Federal Reserve was pretty clear that we are going to help out the market. What happened is that all the participants in the market, a large majority of them, went absolutely berserk, and they priced in a lot very fast. That's very unfortunate. Very, very unfortunate. I certainly think that the Federal Reserve wanted to see the markets rally, but they wanted it to take a much longer time. Everything was just gobbled up very fast, priced in, which certainly is one of the symptoms, side effects, of a heavily algorithmic market as well. It has become very data-driven, a lot of high-frequency trading, so things happen very fast. Back in the day, when a company released an earnings report, it would actually take some time for the earnings to be priced into the stock. Now it literally happens in an instant. In an instant, it is priced in, which is one of the reasons why it has become much more difficult to get an edge by doing a fundamental analysis of a company. You can get that edge if you dig really deep, or if you analyze companies that are very likely traded. But anyway, that's a bit of a digression. The point here is that we have seen that the purple 20-week is a key support level. We like to go back there to find support. We are still very far away from it, notwithstanding the recent pullback. So that's an issue. If we were hypothetically to go all the way down here to test it, like from a current level down here, it would be an approximately 5% more pullback. Yeah, so that's basically what's nagging me here. Is that it's that purple 20-week moving average. It just is. So let's look here at the NASDAQ. Okay, the QQQ. So let's do the same thing. Okay, let's get here the big picture. Let's go way back in time in the time machine here. We go all the way back here to 2004. Guess what? Let's focus here a bit on the 20-week moving average in purple. Here again, it is a key support level. We like to test it very frequently. Test and test. Here it becomes a resistance level, and we plunge very solidly. This was the financial crisis. Here we have a new bull market, and we are frequently dancing around the 20-week moving average. And when we have a solid support, then the buyers step in a big way. So you can see throughout all of these years, it is one, okay, there are multiple, but it is one of the key support levels. Here again, many tests. But then we get the current rally, this rally here. This rally is very different from the previous rallies we saw here in the NASDAQ. We have looked now at QQQ many years. In the vast majority of the time, we don't spend a whole lot of months above the 20-week moving average. We usually rally, we go back and test it. I focused in this video on the 20-week moving average to make the video more parsimonious. It was very much Occam's razor. Of course, whenever you do an analysis of any security, you should look at multiple indicators, dig deeply, because the deeper you dig, the better analysis you will get. Having said that, it's pretty clear that there's something about that 20-week moving average. We saw that. We looked at many years. It's a key support level. But it's also a level you do not want to fail at too much. If you do fail at it, then basically we have a full-blown bear market. So it's a very important moving average. The thing is that both the S&P and the NASDAQ, they recently entered bubble territory. That is never good. There's a saying that bull markets end with a euphoria. There is certainly some truth to that. Hence, the coming months will be very important for both of these indexes. The paradox for both of them is that because we have seen this extreme rally, very bubblish, it would be very healthy for them to actually correct to that purple 20-week and find support. It's much better to have a rally down there than to just try to, go full bug, to just extend the bubble. So it's sort of like a very tricky situation, and this is one of the reasons why we absolutely do not like bubbles, because they create these headaches where it's like this lose-lose situation. If we go further up now, of course, it helps the market, but it becomes even more bubblish, and bubbles, they never end well. So that's a problem. If we go down now and test that 20-week moving average, well, what if we fail? If we fail, then we can have a full-blown bear market. So it's such a mess. Whatever you do, of course, don't fight the trend, and may the trend be with you.